Hi, everyone. Welcome back to the Future of Finance podcast. I'm your host, Marissa Wood, investment advisor and owner of Union Financial Services. And today we have a really exciting guest and episode ahead of us. We are joined by Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. Mark has over 25 years in the industry and is a wealth of knowledge when it comes to stock market investing. So Mark, thank you for joining us.
Oh, it's great to be here. Thanks, Marissa.
So Mark, tell me a little bit more about who is Brookstone?
Sure. Brookstone Capital Management is what's referred to in the industry as a turnkey asset management platform, or a TAMP. And what we really are is an extension of an advisor's practice where we provide all the investment management services. So turnkey, meaning we have full functioning research staff, full functioning portfolio management, market monitoring, and then also kind of the other pieces that sometimes go unnoticed, if you will, kind of the operations aspect, trading aspect, advisor support aspect, as well as some marketing and compliance features as well. But at our root, what we're really doing is building an investment platform of improved investment vehicles, strategies, and some suggestions to help advisors build those portfolios for individual clients.
Okay, great. And what is Brookstone's current assets under management as of October of 2025, approximately?
We are north of 12 billion, on the doorstep of 13 billion. So it's been a pretty good ride. And when I joined about 10 years ago, we were just over $1 billion in assets. And so have really grown over these last 10 years. And I think that it has a lot to do with at least the way we look at service, look at individual clients, but also how we look at investments by having what we call an open architecture platform, with the idea being that markets go through different trends and phases. And what we want to do is have access to different strategies that you can employ during different phases of markets, but also making sure those investments are appropriate for individual clients.
And what does your position as a CIO at Brookstone entail?
Sure. So as Chief Investment Officer, I oversee the entire investment function or platform of the firm. So one area of that, of course, is reviewing or researching different investment vehicles. So that could be exchange-traded funds or ETFs, mutual funds, individual stock strategies, individual bond strategies, structured notes, and so forth. And then also looking at different investment money managers that may manage those vehicles or strategies. And so you do due diligence on those different firms. So some of the firms everyone's heard of, kind of the national brand names, but there's a lot of under the radar boutique managers that we review that you wouldn't have heard of normally. But we do a lot of deep dives and try to expand the opportunity set for investors, trying to uncover different or innovative approaches to the market that may warrant a piece in a portfolio. And so one of the tenets was, and what we did early on was basically come from the view that we think there's going to be a lot of innovation in the investment landscape. And so we want to keep an open mind to be able to review new strategies, new approaches as they come in, and then decide if they're appropriate for different investors. So that's one piece of it, kind of the deep dive research aspect to that. And that constantly changes. There's been a proliferation of new types of strategies in the ETF world, exchange traded fund world, that are appropriate for investors, or we think add value that really you didn't have in other investment vehicles previously. So this is really a new age for investors, that a lot of strategies they may not have heard of that you can incorporate into portfolios that I think make a lot of sense today. The other function is really that portfolio management function, where we try to build turnkey portfolios using an open architecture approach, kind of navigate the platform ourselves, build those portfolios to make it a little bit easier for advisors to plug in and deliver service to their clients. So a number of different portfolios that we run, and they scan from very conservative to a little bit more aggressive for sure.
Yeah, I mean, I can speak to personal experience. Brookstone has helped us scale our practice and introduce innovative solutions to our clients to help them reach their goals. And I will say, having the Brookstone expertise and portfolio designers, it really does allow me to be in front of my client and give them that personalized connection because I have the back office support from Brookstone. And so I think it really does add value to us, but then it passes along to the client as well.
For sure. And I think the way we look at it is, one, at the end of the day, we're always trying to deliver value to the end client and helping advisors serve their client. And two, making sure advisors enjoy what they're doing. And three, allowing advisors to scale their practice, meaning you can grow without it disrupting the client experience. And so being efficient, trying to think through strategies, and doing a lot of the legwork up front, I think it makes a great partnership. And I know we've had a lot of, and I know you've had a lot of growth as well. So we've definitely enjoyed working with you, Marissa.
Yeah, thank you, Mark. So we are heading into the end of 2025. We're in the last quarter. So it really is the perfect time to discuss what this past year has looked like in the stock market. Can you provide us with a bit of a stock market update, state of the market report?
Sure. Well, this has been a very interesting year. In the beginning of the year, we had a lot of uncertainty coming into the year, and then there was what's famously called Liberation Day with the tariff announcements and so forth. And the market really didn't know how to approach that because there really hasn't been a lot of trade or changes in trade using tariff policy as a policy. And so the market sold off very quickly in early April, but then it rebounded just as quickly and has headed higher ever since. So about almost a 6-month rally essentially at this point. And what's really driven the market, I think it's important to point out that this market is unique in the sense that everybody may have heard of the S&P 500. So that's the broad gauge of the U.S. stock market. Well, it's comprised of 500 U.S.-based stocks across 11 different industry sectors. However, today, we have a major concentration in that broad index, where 38% of the entire index is comprised of just 10 companies, so the top 10. And maybe more familiar, you may have heard of the Mag 7 in the news, the top 7 tech stocks, basically. These mega cap stocks have really been driving the market. At the first part of the year, it drove the market lower, where the rest of the 490 stocks actually were about flat, didn't really decline. And then the rebound has been led by those large mega cap tech stocks. Now, what's driven this has been the theme of artificial intelligence, or AI. Well, it's not just AI, it's really the build out of the infrastructure to support kind of this next leg of our economy. What role will artificial intelligence play? And so those large cap companies have embarked on something they haven't really embarked on to this scale, which is a major capital expenditure or spending phase. So combined, the top 7, the Mag 7, are spending more in terms of dollars, so think in the hundreds of billions of dollars, more than the budgets of NASA, Department of Energy, and Department of State combined. So it's a major spend. And what they're spending on are 3 main components, which would be 1, semiconductors or chips. So if you hear chips, those are semiconductors. What semiconductors are is they process and store data. So you may, in your computer, of course, when the computer's thinking, it's processing data. And then when you're saving documents, storing. And that's pervasive across our economy. So I think semiconductors are akin to today's oil in that semiconductors power the modern economy. They're in consumer electronics. The average car today has 1,500 semiconductors in it. So if you remember the picture of all the cars in the parking lot during the COVID pandemic and they couldn't move the cars, well, it wasn't oil that they were waiting for. It was semiconductors that they needed to power the car. So semiconductors are very important. Why they're important for artificial intelligence is you have to process a lot of data. So that's one component. And that's where you may hear of a company called NVIDIA. Funny name, but they're
Yes, we
actually
have.
the largest stock, and their value is over $4 trillion in terms of market cap. It's bigger than Apple. It's bigger than Microsoft. So it's very big. The next segment is data centers. So you need to warehouse the semiconductors somewhere, and you need these big data centers, and they're becoming larger and larger. If you think of a warehouse, kind of this modern warehouse, but all they're doing, they have servers and they're running these large-scale semiconductor processes to think and to produce and to store data. But that data center is just not the building, it's everything that goes into it, from switching to cooling, and all the scale that goes into it. And then the third component, when you're talking about spending on artificial intelligence, is power. You need more power. And this is a multi-year trend. All three of these concepts are a multi-year spend to build out the infrastructure needed. So it's not just, even though the large cap tech companies have really kind of got a lot of the headlines and maybe the market darlings, the rest of the economy is going to benefit from this spend. And I think there's a catch-up phase potentially as we look out through the rest of the year. So I would keep in mind that although you may hear about consumer weakening or softness, and usually the consumer drives the U.S. economy, we're in a rare moment where the business cycle and business spending is driving the U.S. economy. And so this is a multi-year segment. And notice that it overrides any of the kind of the nuances or the headlines day to day that may change and do change. And we're not investing in headlines. We're investing in themes that are driving the overall economy.
That's a great point and a good summary, really, of how this year has been. Now, do you feel as though that focus on tech and AI companies and spending is going to continue in 2026? Do you see any major changes happening where we should shift our focus a little bit?
So from an overall economy perspective, I think the spending continues, meaning these big outlays of cash. It costs a lot of money to do this. But I think from a markets perspective, the rest of I mentioned that the top 10 stocks and have really garnered the headlines, but the other 490 stocks have not participated, nor have really small cap stocks. I think that changes where there's a catch-up phase and the rest of the economy starts to benefit as this spending goes through, because it impacts all parts. And when I say power, you'd say, well, is that utilities and so forth? Yes, those actually have, their growth trajectories have slightly changed from a boring utility company to now having to figure out how to generate 30% more power. And there may be stories pop up where they put these data centers and all of a sudden the electricity bills have gone up for households and so forth. Well, that's because they need to generate more energy and more power to run these facilities, which are all good, except for you need to figure this out and build the infrastructure. So we're in this phase where you got to spend this out. It's not a 6-month or a 1-year spend. It's really a multi-year spend. And the spending really just started about a year or so ago and is really ramped up. At first it was questioned, but now it looks like it's going to continue. So I think it does go well into 2026, but also the other parts of the economy are going to benefit. It's not just going to be kind of those main big tech firms that have benefited. It's going to be the rest of the economy that starts to move higher with it.
That's an interesting point that I haven't really heard anyone else discuss before, that just because those 10 companies seem to be driving the market now doesn't mean that we should not diversify across a lot of different industries, because they will all benefit because of those 10 that are spending more and going to be spending more.
Yeah, it's very interesting in terms of it's almost staggering in terms of the size of the spend, because it's very unusual to see this level of spending and commitment on a project. And it's multiple companies doing it simultaneously. I had seen, there'd been some skeptics on Wall Street where you saw these numbers that would come in on the estimate of the spending, and they seemed awfully low and not really connected with the monies that we're seeing come out. But a recent one I saw was about $2.9 trillion in spending from now until about 2030 That's probably a much more accurate number since they're spending about $360 billion this year, and you factor that it's going to, or at least the second half of this year. So that number seems a lot more realistic when you think about it in the trillions coming out through the rest of the economy. So definitely has an impact that we're monitoring both from an economic standpoint, but also a stock market and standpoint as well.
Okay. Yeah, that's a great conversation to have with a client, because I know I hear weekly, if not daily, from clients that they want a very strong percentage of their assets in tech companies. But maybe let's have that conversation of diversifying for future performance, not just past performance.
I have a great chart that I post up from time to time, which is if you were to invest in the largest company when it becomes the largest company in the S&P 500, and at that point it's the most popular, everybody knows it, it cannot be beaten, and there's no one going to disrupt it or change hands. Well, if you're invested in that, and then once you change from ExxonMobil to IBM or to Microsoft and so on, just going into the largest company, you would trail the S&P 500 over time by hundreds of percent. So the point is, by the time they've gotten this large, you get the large numbers, and it's really hard to really grow further from that start. And you have a lot of the gains already been had, where a lot of other companies haven't experienced those gains yet. And so they're really poised to make some type of recovery in relative terms. But again, that's a really good, to your point, Marissa, which is diversification pays benefits over time. We're just at this acute moment. And if you take Apple stock, for example, from over the last 10 years-ish, and you'd say, oh, I wish I bought Apple 10 years ago. Well, just recently you'd look at that and you'd say, wait a minute, Apple's actually underperformed the S&P 500 over that 10 years. So that's how hard it is to kind of stay at the top, if you will, especially in terms of stock market performance. Still a vastly important company, still one of the largest companies, but from a performance standpoint, you'd be better off diversifying that base.
Yeah, it just emphasizes the importance of people not doing this on their own and just following headlines or their Googling techniques, and really working with an advisor who has a backing of someone like Brookstone to have a diversified portfolio. And that kind of leads us into one of the next topics I wanted to discuss with you, and that is some of the solutions that we have access to with Brookstone. Now, most of the time when we put together a portfolio for a client, we start out with a core portfolio, and then we add a couple satellite or bespoke strategies to that to make it more innovative and exciting. Now, talk to me first about some of those core portfolios and how we make sure they're risk appropriate for the client.
Sure. So just as you mentioned, our overall investment philosophy and portfolio construction approach is based on building a core plus satellite allocation design. And what that means is you build a solid core portfolio consistent with your risk profile, where you have a mix of kind of traditional stocks and bonds, and you diversify amongst the different stock categories: large cap, mid cap, small cap, international, kind of have all the bases covered. And then the different bond categories as well. And I'd say, as a rule of thumb, a moderate or a balanced investor is about 60% equities, 40% fixed income. And then from there, we say, well, what type of core portfolio do you want? So we have some that really track the indexes or low-cost index type strategies, and then a few that use the same idea but maybe take a minimum or low volatility approach to equities. So your equities are actually the low volatility stocks as opposed to buying all the stocks, or it has the low volatility series. And then a few do a little bit more creative, have some active stock selection in there and active bond selection in there. But the whole idea is to have a core risk-appropriate portfolio. And the idea is there we can quantify historic data so we know what's our expected return, what's our range of returns, and how has it performed through several decades. And so that gives us a pretty good foundation. But I think it's also important, that satellite piece, to add that to customize around your core portfolio.
Yeah, I mean, we always start with that risk profile questionnaire. And then for our clients that are listening, we use our partnership with Brookstone to bounce off ideas after we have that risk profile questionnaire and our notes from our client data gathering session. And we see which core portfolio is going to be the most appropriate for you. But then we can always make changes over time as your goals changes and your risk tolerance changes. Because everyone always wants to make the most possible with the least risk, right? But we have to talk about, if we're going to have the opportunity to make the most possible, you are going to have added risk in that.
Yeah, definitely. And I would say on the risk profile, and when you answer the different risk questions, kind of it's trying to gauge your willingness and ability to assume portfolio risk. There are two risks. Most of it focuses around volatility, which is one, how much it goes up and down and gyrates. Stock market is more volatile than the bond market, for example. So more conservative, you usually go towards a little bit more bonds than stocks. However, the second component of risk is the inflation risk. Now, for years, I would say this, but it didn't always connect until you have kind of that bout of inflation over the last few years that we saw, where inflation is the general rise in prices, so it rises and rises over time. So volatility is a short-term risk. It kind of dissipates over time. Whatever the market was concerned about, 3 years ago or 18 months ago, it's concerned about something different now. That volatility has faded. However, the inflation risk continues and is the long-term risk. So I think you want to balance the two. And the reason to put together an investment portfolio is to preserve your purchasing power over time and grow that purchasing power over time. And that's really talking about inflation and making sure you're keeping up with inflation. If you look back over the last 20 years, the price of college education has steadily gone up, has inflated. Healthcare services, cars have definitely doubled in price over that time, houses. But the S&P 500, despite going through a global financial crisis, a global pandemic during that time period, being volatile, has outperformed each of those inflation metrics over time. So you are rewarded over time. But what we want to do is make sure we scale the risk or your exposure to those assets are appropriate given your risk profile.
Yeah, absolutely. Now, so that's the core portfolio. Now I want to get into what I think is the really exciting stuff, and I think our clients would agree is really exciting as well. Let's talk about a couple of the satellite strategies that, in my opinion, really does set apart our firm and our partnership with Brookstone from a lot of other advisors. The first one that we've had great success with, and we have been incorporating into a lot of clients' portfolios, is the stock baskets. Talk to me a little bit about the dividend, growth, value stock baskets.
Sure. What we found was a number of clients liked seeing some of the individual stocks in the portfolio. You'd like to see NVIDIA and Apple, Microsoft, Amazon in the portfolio. And sometimes you don't see that in the portfolio if you're in an ETF or a mutual fund. It's kind of just these broad baskets. Well, what we tried to do was make them a little more specific, to add a sleeve of stocks to complement the core portfolio, which was a little more diversified. And now we have targeted exposure to, if it's the growth stock basket, yes, you see a number of tech stocks and popular tech stocks is now comprising your portfolio with a dedicated sleeve or allocation to that. And then the same with the dividend stock basket. People forget in times like this how important and how beneficial dividend stocks can be, because one, they pay a cash dividend to their shareholders, and that's determined by the board of directors. It's not determined by the market. So as long as the company's doing well, it continues to pay that dividend over time. And just as importantly, it raises that dividend to shareholders over time. So one of the screens we put on is the likelihood that the company will raise in dollar terms the payment to shareholders over time. So if you think about investing in a bond 10 years ago and it's a 10-year bond, well, you just get a steady payout over 10 years. Well, if it's a dividend stock that increases its payout, your dollar amount would double over that 10 years if it's growing at about 7% annually, which is a pretty good estimate somewhere in there. So your dollar amount increases over time. And then you have the potential for price appreciation with those dividend stocks. They're also usually familiar names. So if you go through kind of these tough times in markets where you have a broad sell-off, well, you know the names, Procter & Gamble and Clorox and Kellogg's and so forth, just similar consumer brand names along with some utility names that, they can go out of favor relative to tech stocks, but tech stocks also sell off very hard. And then all of a sudden the more conservative dividend paying names become popular. So they play a pretty key role both in current income and then also growing that income over time. And I think I watched a past episode where you would call that the running back of,
Yes.
of portfolio
Good
construction.
callback. Yes, absolutely.
Yeah, and the growth stocks would be the wide receivers. And we know that a lot of times you overpay for wide receivers.
You do. Yeah, I mean, I think the dividend stock basket is a real winner because we can reinvest them and make sure that we're continuing our dollar cost averaging over time and some more moderate growth. But how is it more beneficial for a client to invest in one of these baskets than to just individually pick these stocks on their own?
So the overall basket, we review kind of as an investment firm. We use a couple of different rating agencies to provide price to fair value estimates, and then kind of have a secondary source to help with the timing of those selections. They use a quantitative method, not to throw out jargon, but that's really the process. In other words, it's kind of a defined process that we go through to select those stocks that comprise whether it's the dividend stock basket or the growth stock basket, and then constantly monitor and refine those strategies. And so we have, we'll change out a few names here and there. The dividend stock basket, those stocks kind of hold for a little bit longer period of time. And when you invest in them, they're usually out of favor because that's when the opportunity presents itself. And then with the growth stock basket, you're really looking at the different growth numbers and making sure you have broad exposure to those different kind of hot areas. So it's definitely different methodology, but kind of going back to it where we don't lose sight of the stocks and then make decisive decisions. Because what I've seen previously is it gets hard to manage a portfolio when it gets hard. There are moments when it's easy, when things are going up, it looks very easy. But then there are kind of these moments in between where, well, the market could sell off, the stock doesn't respond. How do you approach that? And so having a sell discipline, being able to swap out of that and kind of an unemotional sell discipline is, I think, beneficial over time.
Yeah, I have always said that having an advisor involved takes the emotion, or at least some of the emotion, out of investing, which will make you more money in the long run.
Definitely. That process in place and that repeatable process, I think is important to have. I go back, as you mentioned, I go back a while in the industry. And so if you go back to the global financial crisis, stocks were selling off to the point where they were very cheap, but you could get very emotional about it as well because you were in the midst of a major sell-off. And this happens every decline where, at first it's denial and then it gets so bad that it gets painful. But if you try to take an unemotional approach and kind of just follow what you think the discipline is, you'll find that those are actual values, and then you can go in and buy at those levels, for example, even though no one wants to buy at that moment. So to your point, it is advantageous going through these cycles of ups and downs to maintaining your discipline.
Now, talk to me a little bit about buffered ETFs, because I feel like they're gaining some buzz in the industry right now and could be a good solution for those that can't stomach as much risk.
Yeah, definitely. This has been a great area, great kind of innovation that we had been monitoring for about 2 years. They're called buffered ETFs, exchange traded funds. So they trade all day like a stock. But what they have is they'll give you upside participation in the S&P 500 or the NASDAQ, any kind of broad-based index, up to a cap level. So you max out your return, and they tell you ahead of time. This is over a 1-year period. But the important part is they provide downside protection, hence the term buffer. So a lot of these come out and they buffer over a 1-year time period the first 9% of the downside or the first 15% of the decline in the index over 1 year. So if you're to hold for 1-year time period and the market was down 16%, all else being equal, you'd be down 1%. So it really provides a nice hedge on that downside. And then on the upside, they'll tell you the cap, and let's say it's 12 or 15%. Well, if the market's up 20, you're up 12 or 15, whatever the cap happens to be. But nobody gets upset when they're up double digits in that type of scenario. And so I think it gives you plenty of upside. You're directionally in line with the markets while providing that nice buffer on the downside. And so we've seen these grow in popularity and exposure. They're relatively new. So 5 years ago, you really didn't hear this term buffer ETF. And so as we went through the global pandemic and the shutdown and kind of the markets sold off, we were monitoring these vehicles which had very little in assets when we're just starting out. They performed very well. And so it gave us our real-time stress test, if you will, to say, yes, these vehicles are kind of institutional quality. They do what they say they're going to do. Sometimes I get asked, what's a good or bad investment? I would say that's not the right term because it's really looking at it. Does it do what it says it's going to do? And that's how you can at least incorporate. Because there are times when a bad investment could actually look good because the price is down so much, and you say, and vice versa, a good investment might be way overpriced, and it's actually a bad opportunity. So it's really looking at what's appropriate in a portfolio. And so buffered ETFs give that defined upside and defined downside, very unique in the industry. And so they've grown because of providing that hedged equity like exposure. And so these, I'd encourage continued. If you haven't seen these, definitely reach out to Marissa and look through these, because I think they're a great tool for the advisor and client's toolbox.
Yeah, I think it's a brilliant strategy. And what is the liquidity with a buffered ETF? Is it a 1-year term? How does that work?
So it's actually daily liquidity where you can trade daily. The terms come out. They have ETFs listed for each month. So there's a January, February, March, and their terms in terms of the outcome, the upside cap and the downside buffer are for that 1-year period. But during that 1 year, you could trade them. And so what we do is actually monitor how much downside protection is left. So let's say you're 6 months in. Well, it has moved around because markets have moved around. So we look at, how much downside protection remains, how much upside opportunity is remaining, and then we try to optimize that. So we look over the 12-month series and say, these are the 4 or 5 best months that have the best protection levels and the most upside remaining. And then we just rebalance from there, kind of doing that on a monthly basis. And so there is a little bit of art to that, but the terms are for 1 year when you look at it. So there's a little bit more detail to it, but I would say overall, if you think about having a hedged equity exposure, I think it makes a lot of sense. And buffered ETFs are one of the ways I think you can gain good access in client portfolios.
Yeah, I think it's great. It's a great strategy, a satellite strategy for those that want a little bit more risk protection or risk mitigation. Of course, it's not totally protected from risk, but having that buffer in there could certainly make some clients feel more at ease. So that's what we found.
Definitely.
The last satellite strategy I want to speak to you about, and of course, there's plenty more. We could do a whole other episode on all the other strategies, but something that I've been speaking to my clients about recently, and I have been approached about a lot from clients recently, is the cryptocurrency strategy, and particularly Brookstone's crypto strategy.
Sure. So this is an interesting space in the sense that there's a lot of different news out there about what are digital assets, let's use that term broadly, or cryptocurrencies. Mm-hmm. And so there are many different cryptocurrencies available that are in kind of the digital wallet world. So that's a wallet hosted separately than a traditional account. And it has different risk layers to it. What we have are what are now in ETF format, so a familiar kind of proven investment vehicle. Exposure to the top two generally is Bitcoin and Ethereum. So Bitcoin was the original cryptocurrency that started the entire kind of phase. So that was 2009, essentially, when Bitcoin was launched. What
Was
Bitcoin
it that
is
long ago?
yes. And it kind of slowly kind of grew. It was not worth very much. It was very unique on how you could trade it. It was really for techies or hobbyists in that world, if you will, as opposed to kind of an investment that you could make in a portfolio, because it's very small. And so it was created by an anonymous creator named Satoshi Nakamoto. No one knows who the creator is, but what it was a computer code that solved the double spend problem, also known as the Byzantine generals problem in computer science, which was, well, you can make a digital copy out of anything. How do I know this is just the one issuance? So anyway, computer science, he solved that. And then the economic view was that, this is kind of a digital gold, if you will, because there's a limited supply. There's 21 million Bitcoin that's going to be issued. And every 4 years, the amount of Bitcoin that's issued drops in half. And so those are called rewards that you get. So really the value proposition of Bitcoin is it's like a digital gold where you have limited supply over time. You kind of have a defined supply over time, how much will be released and so forth. Instead of being a physical attribute like gold or have those properties, it's completely digital. So if you see pictures of kind of a bee and a coin, there are no coins. Yeah. It's just a digital asset. And then Ethereum is the second largest. That one was created a few years later to try to do some things that Bitcoin did not do and be a little bit more flexible in terms of its use case. And so those are the two largest. Bitcoin's over 2 trillion in assets, and I think Ethereum's probably around $500 billion. So they're sizable. And the way we do it is that we use the ETFs, exchange traded funds. Now, those were just approved less than a year ago in that format. We had actually invested in or gave access a few years back, maybe 4 years back, to similar vehicles that we thought were going to get full ETF access, which means they hold Bitcoin similar to the gold exchange traded fund, which owns gold and just holds that asset. And so that owns Bitcoin, then it owns Ethereum. We have multiple ETFs that do that. And then also include an ETF that basically is the picks and shovels of Bitcoin, kind of the firms that work inside that industry as well. So I have pretty good broad-based exposure in terms of our overall allocation. So a lot of people have a lot of different opinions on cryptocurrency. And what we're really saying is that it is more volatile. It's a nascent technology in a sense. But if you want access, we have put together a turnkey strategy that would incorporate and give you exposure to that broad industry.
Yeah, I mean, it's a great strategy, just the way people have been using gold and silver ETFs to gain exposure to that asset class. We can use this Brookstone crypto strategy to have ETF exposure to
Correct.
these funds without actually having to buy Bitcoin or buying Ethereum.
Correct, because it takes away some of the risk. See, some people think the risk is specifically in Bitcoin or Ethereum, but it's really been in the custodians of the digital wallet space. And on top of it, here you're custodying it. It's in a traditional account, ETF format, as full oversight and so forth. So it takes away some of the risks that have occurred in that industry over the last several years. And so I think it's the right vehicle for most investors that wanted a piece in the portfolio.
So those are just a couple of the satellite strategies that our clients have access to thanks to our partnership with Brookstone. Now, Mark, is there anything else you wanted to add, or if advisors, independent advisors throughout the country want to get in touch with Brookstone and have a partnership similar to the one that us at Union Financial have with you, how can they get in touch with Brookstone?
Sure. I'd just say, just to wrap up, I know there'll always be headlines, and we're trying to invest beyond the headlines and also incorporate a lot of these new or bespoke strategies that we think play a role in overall portfolios. So it's definitely not the end to what I think the roster will look like, but we always have our eyes open to add new strategies as appropriate and be where the client is and where the investment themes are. And then if anyone wants to get a hold of us, and for individual clients, we work directly with advisors, so we're a dedicated advisor shop, and obviously reach out to Marissa. And then any independent advisors, it's brookstonecm.com, Marissa.
Thank you. Thank you so much, Mark. It was a true honor having you on today. I continue learning from Brookstone and your team every day, and it helps me be a better advisor for my clients. And for everyone watching, thank you for tuning into this episode. I hope you learned some key market insights and some strategies that you might want to take into 2026. I'm your host, Marissa Wood, with Union Financial Services, and we look forward to helping you live a better financial future. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.